AI will fundamentally change not just the way we do business, but the efficiency with which we do business, which is good for pricing, the precision with which we do business, which is good for pricing.
It still comes down to having somebody be able to listen to what that broker wants.
When we have more origination volumes, usually regulators tend to bring in a little more scrutiny in there to make sure the quality of that ongoing volumes is good and stable.
Around probably 35% of all the securitizations of all the deals will be non-QM today.
Now, for all of us looking to buy a home, that's good news.
Good afternoon and welcome to today's Mortgage Horizons 2025 webinar from A&D Mortgage. We're going to give things a couple of seconds for people to start getting in through the lobby. We'll do the quick introductions. Our panel today is comprised of Max Slyusarchuk. He is the founder and CEO of A&D Mortgage. Bob Diamond, founding partner and CEO of Atlas Merchant Capital. Rob Chrisman, the moderator of today's panel, and he'll also be speaking as well. He's the creator of the Chrisman commentary. And then Alex Suslov, he is our head of capital markets for A&D Mortgage. We'll go over the agenda really quickly, but just quick webinar etiquette. We will be recording this. You should be getting a copy of the recording in the next 24 to 48 hours. We would ask you to use any questions you may have for any of the panelists, put them in the Q&A box, and we'll be moderating that throughout the course of the day. And then we've disabled videos and microphones for our viewers so that we can have a clean recording. And the last thing is if you guys could give the courtesy of our guests by turning off your cell phones and limiting any business that you might be doing, even though we can't hear it, at least that way we're going to be getting a lot of really good information out of these gentlemen today. So let's go ahead and get started. I'm Carl Holman, the communications director here. Next slide, please. So for those of you who don't know anything about A&D Mortgage, we are the #1 officially verified non-QM lender. We have been in business. This is going to be our 20th anniversary year. And we've built over that time a partner network of about 6,500 brokers and brokerages. And we were also verified as, which one is that? The Originator Choice Award. We're licensed in 47 states. We should be finished with the remaining 3 before the end of the year. And one thing you can absolutely expect from us is if you reach out to contact us, whether it's underwriting, account executives, you'll get an answer within 30 minutes or less. We pride ourselves on our customer service. So as I mentioned, we've been in business for 20 years. Max can tell stories about the founding if there's a chance to do that. We are backed up by a company called Imperial Fund, and that allows us to securitize our own mortgages on the capital markets, which Alex can talk about, as well as Mr. Diamond. So we've done approximately more than 20 securitizations over the last few years. We've got a few more on the books that we anticipate doing this year. So we're very healthy and firm, and we enjoy doing business with everybody. In terms of where we are located, as I mentioned, 47 states. We're just missing Alaska, Hawaii, and South Dakota, and we're pending in a couple of other states, but that should be worked out before the end of the year.
Carl, what's wrong with North Dakota? Why didn't North Dakota make that first?
I don't know. I don't know. There's not a lot of people that want to do business.
I think we're just pending a license there in North
Dakota.
Yeah,
there seems to be a lot of lenders that just don't have. My previous institution also didn't do North Dakota, but
I was kidding a little bit. But
yeah.
I did have a more serious question.
It's a beautiful state, though.
I've seen A&D and AD. What is the difference between the two?
Well, that sounds like the perfect question for Max.
Yeah. Official name is A&D Mortgage. And as a complication with the name, we also have AKA, like A&D Mortgage. But official name, there was originally registered as A&D. So we use both right now.
Okay.
Right. So I will turn it over to you, Mr. Chrisman, and I will go off camera, and I'll be back before we're done.
All right. Max, thank you for that. I didn't mean to derail the entire show, but I've seen it both ways, and I thought maybe one's a DBA or one's like a big holding company, and the other's actually the origination side. So, thanks for clearing that up, and thank you to the panel for joining, and thank you certainly for the attendees who are spending their Tuesday morning or afternoon, depending on which time zone you're in. Joining us here today to learn about what's going on a little bit out there. And, Max, one of the things that as an industry I've noticed happen over the last several years is so many lenders and so many originators have gone from Fannie, Freddie, FHA, VA, then they start maybe going into USDA, and maybe they start going into bond programs, and then they do a little bit of that. Maybe they'll open up a reverse division, whatever it is. And as the years have gone by, and certainly as volumes have gone down here in recent years, lenders have been much more open to non-QM lending, which for years, we've kind of been getting, hearing about, oh, non-QM is right around the corner. Oh, it's really going to take off, really going to go do this, really going to go gangbusters. And it kind of ebbed along for a while. And then lately it shot up. And of course, I like to say nobody has a crystal ball, but where do you see non-QM lending going in 2025? And what can the brokers on the call do to prepare themselves or educate themselves for that kind of market, other than just, get signed up with A&D and call it a day?
Well, as we all know, and you've been, Rob, in the business long enough, prior to 2008, the private label securitizations were way more popular. It was a lot of them. So it's not exactly non-QM, but non-QM, if you would roll it back and say which loans we do, I think that around probably 35% of all the securitizations of all the deals would be non-QM today. So it's a huge gap between, we are at 7% compared to all the outstanding loans to 35. So we believe that it's gonna just only grow if there are no other major events will take place as pandemic or anything else. So there's a huge gap, big void. The issue is that a lot of different guidelines, a lot of different points that brokers are not familiar with, but there's a huge growth opportunity ahead of us in non-QM loans. That's why all the brokers are started looking into that as margins go down in conventional, and there are less conventional business. There are way more interest in non-QM business naturally, and there is a huge opportunity in non-QM world.
All right, good. Yeah, it's certainly a conversation topic out there. Another conversation, as we all know, is interest rates and the Federal Reserve and the new administration and so forth. And I want to ask Bob, in terms of what you're seeing with regard to the Federal Reserve's, what is the Federal Reserve? Is inflation under control? Is the Federal Reserve done? Are we still going to see a volatile environment from here on forever? I mean, what are your thoughts on the general trend in interest rates and the Federal Reserve's role in that?
Thank you, Rob. I think our view is very clear that the Fed will be very cautious in the period ahead. Some of that is politics, but I think put that aside, we're all kind of used to how that plays a role over the last 6 months or so already. But if we look back over the period of low interest rates to high interest rates to where we go from here, the Fed clearly waited too long. And when they waited too long, they stoked inflation, or they were a part of the cause to stoke inflation. And so when we look back and we had inflation at one point as high as 9% and the impact that was having on things like mortgage rates, we have to say the Fed played a blinder. maybe they waited too long and allowed inflation to get too high. But frankly, the way they managed the rate increase while keeping the economy strong while bringing down inflation was probably better than the vast majority of us could have expected at the time. So give a big tick to the Fed and Chairman Powell. But I think that is important to recognize that going forward, they're going to go out of their way to avoid reigniting inflation. And I think the risk they face is with a strong economy. And we all know the phrase animal spirits in the last 24 hours or so. But with the new administration coming in and the optimism out there, the economy is clearly going to get a bit of a boost, everything else being equal. And I think the Fed will be very cautious of easing into a stronger economy, really for two reasons. One is their legacy. If they're seen to do a second round of inflation kind of being a force in that, I think it will impact the legacy that this Fed has. But I think secondly, they recognize that holding their gunpowder, if I can use that phrase, or the rate cuts for when there's a potential need for them with a slowing economy. So I think the consensus that rates are kind of stable to declining is correct. But I think we give too little thought to the fact that if the economy is stronger than expectations, and if inflation rears its head a little bit, that we could see an increase in rates over the next couple of months as well. So I think it's going to be very balanced. I do think that the likelihood is flat to lower interest rates, Rob. But I think the Fed will be more cautious than consensus expects today. And that's both because of the potential impact on their legacy if inflation does rise due to rate cuts, but also due to the expectation that the economy is in fairly good shape. Now, for all of us looking to buy a home, that's good news. You don't want to see rates go to zero because the economy is very weak. So I think that the feeling that there's going to be a strong economy going forward is consistent with the willingness of people to put money into homes, particularly first-time buyers.
So partly cloudy with a chance of rain or a chance of sunshine. I got it.
I would say pretty sunny, but a chance of cloudy. I would say it the other way around, but
Okay.
I'll let you interpret it.
No, I'm not going to interpret it. I've never heard a broker tell a potential client, you know what, some expert out there thinks rates are going to be lower in 3 months, so I can't help you now. Come back in 3 months. It's a fact that brokers are going to try to help their clients now, or any loan officer will try to help their client now with programs and sharp competitive prices and great service, regardless of where interest rates are going. Leading up to and including the election, the big topic of conversation among lenders was, what about interest rates and inflation and so forth? And then the other big topic was on the regulatory side. What's going to happen? Is the CFPB going to be obliterated? What's going to happen at the state level, and so forth and so on. I wanted to turn to Alex, and Alex, ask you terms of what you're anticipating for 2025 in terms of regulatory changes, and how will those impact origination and the day-to-day lives of originators and underwriting standards?
Thank you, Rob. Sure. So I would say, given that we're in the environment with the sunny sky these days, and as Rob mentioned, the rates environment to be somewhere in a stable to declining stage, we are to see more origination volumes. And when we have more origination volumes, usually regulators tend to bring in a little more scrutiny in there to make sure the quality of that ongoing volumes is good and stable. So I would expect some regulators to tighten a little bit the requirements. And also we see, just had recent conversations with agencies which mentioned that There are some additional capital requirements that were implemented for them, thus elevating a little bit the rates for agency products in the coming months. Is that what we see out there? So all that might be affecting a little tightening of agency production overall, which is a good side for non-QM business as well. When agency production have some fallout, we have other means of verifying income and verifying the ability to pay for our borrowers.
All right. You know, one of the things that I've seen, I think we've all seen, is with the waning days of the Biden administration, the CFPB has been very active, and not only with mortgages, but with car loans and with medical debt and so forth. And it seems like people in our industry are thinking that, all right, we probably are not going to do away with the CFPB. In fact, I would bet $1,000 that we won't see the end of the CFPB. But given the prior administration's choice for director of the CFPB in the form of Kathy Kraniger, she was much more open to hearing from the industry, and rather than shooting first and asking questions later, to incorporate what the industry was seeing out there in terms of rules and regulations and so forth. And I think the industry is hoping for a return to that. But we'll see what happens there. I wanted to narrow the focus down a little bit in terms of, and Bob, you and I we're gonna come back to interest rates here in a little bit, but you can't go to a conference now without some session on technology or multiple sessions on technology and innovation and where we go, what we do. And Max, I wanted to ask you, A&D is known for having solid technology. So congratulations on that. And the brokers that I've talked to like working with you. What kind of emerging technologies are you seeing without offering up any secret sauce? I'm not looking for like something you're going to roll out 6 months from now, and I'm not looking for secrets, but do you see anything, quote, disrupting or really changing mortgage origination this year?
Well, like you said, Rob, that you have to have technology if you want to succeed in mortgage business, and if you want to grow, you have to have a huge technology investment. You need to have a technology focus, and we are doing this for many years. And I see that what everybody talks about is a lot of AI, involving AI everywhere. So we've been taking this seriously. We've implemented the new AI chatbot that we have all our guidelines and all second lien guidelines, jumbos, that any broker online can go into our chatbot and ask a question and figure this out. We're also coming out with non-QM AUS in 60 days, which will be a game changer for non-QM, because there is no AUS for non-QM. Everything is manual. There will be a big splash, but you have to have a lot of technology to succeed. And this even creates an unfavorable treatment for lenders who do not pay enough attention at this. But we believe that the huge thing this year is going to be using AI in doc recognition, in AUS, in origination, in communication, in chatbots. So that's the future.
Bob, do you concur? I mean, you see the industry as well as anybody. Do you agree with that?
Yeah, listen, I think across financial services, to Max's point, let me be very clear. AI will fundamentally change not just the way we do business, but the efficiency with which we do business, which is good for pricing, the precision with which we do business, which is good for pricing. It's going to be a fundamental change. But I would I would add two pieces to that introduction, which is AI is really, 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 really important to the overall mortgage market. I would say that today, the vast majority of tools we need are available, but are not being used. And so when you look at a team which is managed as well as A&D, you know they're going to be at the head of it because they're all about execution, execution, execution. The leadership of A&D is insisting on the adoption of AI, and it's part of what they do every day. And then the second thing I'd say is when you look at the large platforms, the big incumbents, whether it's Bank of America or whether it's Rocket Mortgage, the ability for A&D to out execute in this regard is really, really serious. Our platform is much more agile, mobile, better managed than the very large, complex platform. So with all the great service we've been giving and the great pricing we've been giving, expect that to improve relative to the large incumbents going forward.
So Max or Alex, give me I'm still sitting here with my flip phone. Give me an example of how AI might impact the average originator or broker who's out there. Start with Alex.
I would say simple thing, especially in the non-QM world where the guidelines are not that standardized. For example, as an agency where you can go to pretty much the Fannie Mae website and see what are your requirements for reserves or anything. You can go to the chatbot that we implemented. You type in any question you have, sitting with borrower face to face, and say how many months of reserves I need for a national borrower, for example, and you get an instant response which you can relay to your borrower. That simplifies the way that you talk to your clients, and that makes you more efficient. You know that you can get instant response in seconds and be confident, and without needing to create heavy Excel spreadsheets comparing different lenders, comparing different parameters and all that.
All right, good answer. Max, anything you'd like to add to that before we?
Yeah, to the Bob's point that AI will end up in giving us more competitive pricing. Why? After the great financial crisis, a lot of regulations came about and it's increased the cost to originate to the sky. Today, and I know last 7 years, cost to originate loan was humongous. Why? Because extra check and compliance, underwriting, QC, another QC, and all these extra things that you have to do are extremely expensive. If we can plug AI in a lot of spots, you can automate that, and you don't have to do that. You can bring the price down, making it more price efficient.
All right, good. Yeah, it seems like when I was running capital markets department, we would have quote a deal desk where brokers or originator LOs would call up and they'd say, hey Boris, I've got this yurt on 10 acres outside of Casper, Wyoming. What do you got? Whereas if you can automate that deal desk function at least, it seems like more efficient. But speaking of, we're going to switch gears here. That's a poor switch to demographics, talking about yurts in Wyoming. I wanted to ask Bob, once again, from your vantage point, the brokers on the call and originators on the call are basically running their own small businesses, and they're dealing with people on a day in and day out basis. And they see population changes, they see people moving, they see people staying put. They see just this wide cross section of borrower who's out there. Bob, what trends do you see in terms of home buyer demographics that are going on out there that originators should know about, especially among people who are under the age of, let's say, 40?
Well, that would include me, of course. So happy to answer that for those of us under 40. Listen, I've been looking at some outstanding research that McKinsey has done, and if you look at Gen Z, and when I think of Gen Z, I think of people that are 12 to 28 years old. The core of Gen Z, and the McKinsey research shows that 75% of people in Gen Z would have expectations of acquiring a home in the next 5 to 6 years. So think about that. Gen Z is about 20% of the population. If 75% of that 20%, so we're 14 or 15%, are going to buy a house in the next 5 to 6 years, that is a huge impact on our business. And I think if you step back from that and say that home buying is coming from Gen Z, people 12 to 28, I think it also screams that we need to be modern. We need to serve them as the kind of clients they are. They want apps. They want technology. They want digital. They don't want to walk into a JP Morgan office or a Bank of America office downtown. They want to do it online. They want to do it on their phone. They want to get data. They want to get numbers. They want to shop. So again, advantage is not to the big, fat incumbents with big offices. The advantage is to those with technology and real digital customer service. And I think the second thing is, if you think about what they're thinking about, and I think this is different than my generation or any generation, is it's not going to be driven by interest rates. It's going to be driven by their ability to have a down payment. So we need to pay very, very close attention to that dynamic. It's going to be less about interest rates and more about capital. So I think it's a very, very interesting 4, 5, 6 years ahead of us. The biggest impact will be Gen Z. 75% of them hope to buy a home in the next 5 or 6 years, and they're gonna be shopping on their phone, not in the showroom of Bank of America.
Yeah. Then there's always the bank of mom and dad, right? That's something when you talk about capital requirements.
It's a cheaper bank. Yeah, best rates.
Exactly. The interesting thing, I mean, we've been, for the last several years, we're talking to move up a gen to people who are in their late 20s and 30s right now. It seems like all the analysts out there were wondering, is this generation going to go to college? Are they going to get married? Or where are they going to live? Are they going to get jobs? Where are they going to work, et cetera? They've been almost overanalyzed. And now we're dealing with a younger generation who, if I was 15 years old, owning a home was so far, I mean, I wouldn't even think of owning a home or even being asked about it in a poll. But obviously, when you get into your early 20s, mid 20s, yeah, it's an issue because a lot of your friends are doing that. And one can argue that home builders have been lagging for a number of years in terms of building homes to satisfy this demand. And I wanted to ask Max, when you talk about housing supply shortages and the challenges of affordability, whether that challenge comes from homeowners insurance costs or permit costs or mortgage rates, whatever it is, how might non-QM products at A&D evolve to meet those challenges?
Well, we think that even though the rates are up and sometimes it takes a little longer to sell in different pockets of the country, there is some places still a shortage because we haven't been building for quite some time at the pandemic and a couple of years after pandemic. So we are still very healthy in terms of values of the properties. A little shortage, the optimism on the market with new administration and sunny outlook, but non-QM is helping to affordability, meaning that we have a lot of clients that we are getting from conforming worldwide, because for 2.5% and 3%, the business owners would qualify to get a conforming loans. With the rates today, they don't, so they have to turn to the alternative way of qualification, which is a bank statement, DSCR, whatever it is, and that's where they turn into non-QM. So there are more non-QM buyers percentage-wise if you compare non-QM to GSE than it used to, and it's increasing every month.
Interesting. Alex, a company, I've used this analogy before, you're not going to manufacture a car unless there's a buyer for that kind of car, as you would find out with, the Ford Edsel way back when. Companies are in the business of manufacturing loans that they can sell or put in a portfolio somewhere. How do you think, given that your specialty is secondary market, how do you think the secondary markets are likely to respond, if at all, to an increased demand for alternative lending products, non-agency products this year?
I think, and it's a good analogy, Rob, with the car manufacturer. When you have a larger demand from clients, you start first either producing more cars and raising also prices. But for us, it's meaning if we can have a better demand on the secondary market, we can sell loans at their better levels, loans and bonds that we produce, meaning we will be able to tighten spreads and offer better rates to our borrowers. That also brings with the increased demand, better rates, that brings an opportunity to come up with other, if it's cars, car models, if it's mortgages, other products, some niche products, more second liens. You will see more investment deals on the market. So overall, an increased diversity of the products offered, suiting different, more specific needs, and also to the same point of their affordability, right? Help those clients, those niches where there is not enough demand today. With growing demand, we'll be able to serve more clients across the US.
So, Alex, I don't think you were in this business, let's say 17, 18 years ago, but the part of the industry had gone to where originators, lenders would tell the investment banks what guidelines they wanted to originate loans under, and then ask that investment bank to buy those loans under those guidelines, almost as if the tail wagging the dog here to some extent. But the originators would say, all right, we've got borrowers who will love this kind of product. Will you buy it from us under these guidelines? And then the investment bank at that point would, they would look at the numbers and they would analyze the risk and so forth and figure out, okay, do we want that product? Can we securitize that product? Can we sell those loans in the secondary market? Alex, do you see that happening again potentially, where originators tell Wall Street or tell insurance companies or pension funds or money managers, hey, we have an appetite to originate these kinds of loans. Would you be interested in buying them?
I'd say to a certain extent, as long as it falls in line with the regulations and meeting the ability to repay of the borrowers. That may be also seen in the certain buckets, for example, not necessarily guidelines, but let's say interest rates. Agencies may be asking originators or lenders of where you want to fall as far as interest rates. Let's say you focus more on the lower rates, or you focus more on the loans with higher credit scores. And you can see that with agencies where they try to allocate also some particular pricing for particular lenders for in the affordable housing in certain states, in certain FICO and certain incomes, like low income, medium income, to make sure that the country, the nation is well served.
Yeah, it'll be interesting. You talk about the nation being served. You know, just had the election. We just had the president sworn in yesterday. Housing policy wasn't on the front burner of the campaign, but it was certainly discussed during the campaign, and it's come up since the election. And there are people out there who say, you know, the federal government can only do so much. It's not like, and I'm not going to pick on Donald Trump, but any president, it's not like the president can wave his or her magic wand and set interest rates. It's not like they can determine the price of a utility hookup in a local community in, you know, Arizona. It's not like they can make builders build more homes. It's not like they can tell the insurance companies how much to charge for homeowners insurance. So there's a school of thought out there that says the federal government can only do so much with regard to housing policy in terms of affordability. There's another school of thought that says the federal government and the administration can do a lot in terms of changing the housing policy. And you know, we're waiting as an industry to see what might happen, for example, with Fannie Mae and Freddie Mac, the GSEs. Are they going to be released from conservatorship? What will happen? You know, Bob, you mentioned capital earlier on. You know, what will happen with regard to FHA or VA, potential capital requirements, capital changes? I've heard that, for example, the FHA delinquency rate has been creeping up a little bit and raising some eyebrows. So it'll be interesting to see what the federal government might do with regard to that. I wanted to ask, you know, Max, you know, throughout all this, I mean, you have a lot of brokers out there, Max. They are individual entrepreneurial business people, and they are dealing with whether it's rent or, you know, how much to pay to have their plants watered every week, or what's going on with global economics, US economics, and so forth and so on. And they want to be competitive. They, of course, want to give great service, great products at a competitive price to their clients. And part of that obviously has to do with technology and digital offerings. And I want to ask Max, when you're talking about collaboration between brokers and lenders like A&D, what do you see happening out there? What trends do you see?
Well, we see a lot of void of information regarding non-QM, how to do this, how to sell, how to put together a loan. And we creating right now like A&D University, where we're gonna take a very strong approach on teaching and communicating with our partners and delivering them as much information as possible. So the information void, the courses, the something that they can send the new guys to a course like on the weekly basis, the certifications that we're going to provide on the non-QM level competency. That's what we are coming out with, and that's what all lenders should be doing, basically bringing more knowledge to our partners and giving them all the tools they need to be successful.
Yeah, I would think to follow up on that question, I would think that the broker demands for, let's say, A&D are more than they've ever been before. They expect more from lenders, from A&D than ever before. Would you say that's a correct statement?
100%. Every month we're coming up with new ideas and new tools that we want to share with our partners. And make them do more loans, making them more successful, giving them more information, and trying to give them as much as we can. It requires a lot of work, innovation, but we are very determined in being a one-stop shop and being relevant to our partner.
Yeah, collaboration, communication. Alex, turning back to you, it's a two-way street. When you talk about, okay, A&D is offering this, but there's also, what do brokers want? What do their clients want? And how do you, A&D, collaborate with brokers, with your clients, in terms of their clients' needs, whether that's multi-generational housing or foreign nationals or some need that they have? How does that communication work?
Like Max has mentioned, we're encouraging our brokers to use the tools that we provide. We have a concierge service. We have a scenario desk where brokers can reach out, ask questions, see what is the better way to approach their clients. Also get some help from us in calculating borrowers' income and running their scenarios, checking their visas, their like foreign national immigration status, all that. Also, we just recently started a new rewards and loyalty program where we encourage brokers to participate in the educational webinars and different things that allow brokers to earn rewards in order to attend A&D events, A&D broker events, meet A&D team, sales team, leadership team, appraisal team, and make sure that the brokers are involved in all the different processes and understand the flow of the loan in the ecosystem.
All right, we have a question in the chat from Steve. Does A&D have a green appraisal panel currently, or is that something you've considered if you don't have it now? Max or Alex?
Alex, go ahead.
A green does any have a green appraisal panel to help builders get credit of higher appraisals for buildings with more energy efficient homes? Right now, I don't think we have a panel that would facilitate appraisers to, if I understand the question correctly, to kind of give a value of the energy efficient homes. Nothing in particular to that, but we do follow the Freddie PACE requirements on the buildings and the houses that have energy efficient materials, energy efficient tools, and like solar panels and things like that.
Yeah. So there we saw an example of real-time collaboration and learning about the demand for something. And once again, it involves consumer behavior and what the clients, what's going on with them. And I wanted to go back to you, Bob. Consumer behavior, I mean, people are always studying other people and what they're doing and why they're doing it and what they're buying, what they're not buying, and how often they're buying it, and what everything. We're overstudied. It seems like sometimes I can't even go to a gas station, and by the time I get back to my laptop, there's a survey question about how was your gas station experience. I mean, it's just sliced and diced and analyzed so much. How do you see, Bob, consumer behavior changing in 2025? And what do you think borrowers should expect from their broker going forward?
So I think first and foremost is delivery. And I think, the best example I can give of what what our clients don't want is what my generation went through when we had to get a driver's license, which is going to the Department of Motor Vehicles. You know, it's slow. It's closed half the day. There's long lines. It isn't user friendly. And I think today it's the polar opposite of that. It's technology, and it is digital, and it is delivery one-on-one from us who are providing the mortgage right to the client. And so I think customer service is a lot about technology, and then away from that, boy, they have a way to shop our terms. And so we also need to be the most competitive for the products that we care about. So fewer products, more excellence, greater pricing, total transparency, and deliver it digitally and with strong technology. And I think, you know, I hate to say it, but that's not what's going to win. That's kind of table stakes. That's what's required to even be in the game with Gen Z.
Yeah, I would agree with that. Table stakes is a good term. Yeah, you definitely have. I mean, the mortgage industry is just a great example of the need of the consumer and the need from the investor, and linking those two up. And you know, Herman asked a question that I want to flip to Alex here briefly. You know, how is the current secondary market performing? And are investors actively seeking non-QM products at this point?
I would say that the secondary market for non-QM industry and for private label RMBS securities is very strong in the most recent several months. We see spreads tightening, and that's given the previous conversation on the demands, right? As long as there are demands from the end investors, pension funds, endowments, we will have a better performance in the secondary market, which would allow us to offer better interest rates for our partners. And with the current interest rate environment being stable to going a little down, as mentioned before by Bob, we will see more demand, because what happens, the risk of the end investors, like we saw in 2023 when banks and funds were buying investment products to their portfolio, and then you're marking every month your portfolio down, down, down. There is scarcity, and fund managers tend to cut on their investments and wait until better times. When your assets on the book are stable or growing in value, there is a demand to increase the portfolio volume, which benefits the secondary market for mortgages.
All right. Well, we've got about, thank you, Alex. That's a good answer. We've got about 10 minutes left. And I'm going to ask each panelist for, if you could give brokers and lenders on the call one piece of advice to prepare. I mean, heck, we're already halfway through January, but to prepare for this year, what would that one piece of advice be? And Alex, we'll go back to you, and then Bob, and then to Max. So Alex, one piece of advice for brokers out there.
I would say for brokers, the most important is to identify your niche of clients, know who your customer is, and target that audience. Make sure that you offer right products for them, right technology, and best service. Sometimes it's a little tough when you try to spread out and serve everyone, do reverse mortgages, second homes, and also DSCR loans. So focus on one thing. Make sure that you stay up to date on the new developments, on the new updates on the programs and the new technologies. Make sure that it is the workflow and the process of origination is streamlined, and you utilize the maximum technologies possible, and that saves you money, saves you time, and what's most important, makes your client happy.
All right, Bob, one piece of advice.
So two, very, very different. I would say for the brokers and lenders, be prepared for a wave of consolidation. I think the industry is prepared for it, is ripe for it. I think the economic environment is ripe for it, and I think it's keep your eye on firms like A&D and their opportunity to take what is a really, really, really strong business, which has grown heretofore organically, and to be a winner in consolidation. I would say, secondly, in my words, speed is a virtue. Speed is important. And again, I'll go back to Gen Z. They want speed and they want accuracy and they want it delivered digitally. So AI, technology. That's how we're going to serve the customers of the future.
All right, good answer, Max.
I very strongly believe that, as we discussed that in the beginning, non-QM business will grow. So I would suggest our partners to pick one or two best non-QM partners that you believe is good for you and stick with them. Don't do business with a lot of the non-QM guys, because each and every guideline is different. Each and every way they do business is different. The workflow, the speed, the people, and having just two lenders in non-QM and study them real well, know their guidelines, know the technology, and try to look more into non-QM space. It's very promising, and that's where the future is today.
I tell everybody to pick a couple of non-QM lenders and start alphabetically and use those.
I don't want to say our partners should pick up the lenders that they believe are the best, the most stable, technologically advanced, and suit for them.
Right. Not that I'm asking for my own advice, but if I were to give, I do give advice regularly. It's don't be afraid of telling your counterparties what you want. You don't want to hear from, if you're a broker, you don't want to hear from A&D, well, I can't read your mind. Why didn't you tell me you wanted this, 3 months ago, or whenever you thought of something that you needed or wanted? Let us know. Keep the communication open. Going back to what Alex was talking about, the collaboration and communication that people have, it's so important, and it's a value of people versus, we talked a lot about A&I, Max, and I know you're an AI fan, but it still comes down to having somebody be able to listen to what that broker wants, because those brokers and those originators are dealing with clients on the other telephone line, and they know what they want. And so to be able to relay that information up to A&D or whatever lender, my advice would be don't ever be afraid of giving them a wish list. Max, shooting you an email saying, hey, it sure would be nice if you did this, this, and this, because that's how a lot of change happens, and a lot of change for good. Okay, we've got about 4 or 5 minutes left now. Oh, we've got Carl back. I guess we're out of time. Carl, what's going on out there?
This is your 5-minute wrap up. Sorry. Yeah, this is usually where we do our quick closeout and let people know what's going to be coming. So at this point, we don't have any more questions sitting out in the queue. So good job at answering the ones that have come in. As we talk about it, education is also a huge part of our background, as Max was talking about with the upcoming university that we're in the process of developing. But until that's ready, we still have webinars that we do a few times a month. So we'll be spending some time in February talking about second mortgages. We'll reintroduce our normal broker orientation to people who either have never worked with us before or just hearing about us for the first time and are curious. You can tune into the broker orientation, learn a lot more in depth about the process, the products, the things that you've heard Max and Alex and Mr. Diamond discuss. And Alex had also talked briefly about the loyalty program. We will do a deeper dive as well into that towards the end of the month. And we'll be hitting a milestone soon with our loyalty program. So keep an eye out for some interesting news in the next couple of weeks as it comes to that. And as we mentioned earlier, you know, if you're going to start with a non-QM lender, start alphabetically with A&D. So if you would scan this QR code and are not currently a partner with us, this will take you to the homepage on our website where you'll be able to start the process of filling out a broker package, and start working with us on a regular basis, and get to interact more with people like Max and Alex and a lot of the behind the scenes people. We've talked a lot about the AI, but I think Max would also agree the heart of the company really is also the people. And he's made it a point to hire the best. And we're proud to work with him and happy that he's our leader.
Clearly. All right.
All
Thanks,
right.
Carl, for putting this on. And thank you very much to the panelists.
You're welcome. And our behind the scenes panel is the one who really pulls it off. I don't want to take all the credit. I just get to be the pretty face.
Thank you, Carl. Pleasure
Yeah,
being here.
yeah.
Thank you.
Yep.
Thank you
Mr.
all.
Diamond. Thank you, Mr. Suslov.
Thank
All
you.
right.
You're welcome.
Take care, guys.
All right, bye.